Welcome back to Switzer. In the absence of Roger Montgomery, we had the CEO of Montgomery Investment Management, David Buckland, to come off the bench and pinpoint two stocks where the intrinsic value is greater than the current share price. Welcome, David. How are you?
Thank you, Peter. I'm very well.
It's nice to have you here, but I do miss the ability just to tease Roger a little bit, you know?
Yeah, it's good to tease Roger.
It is. He takes it so well.
He takes it very well.
Anyway, so this kind of criticisms I give him or nudges, I'll try on you, but I'm not expecting the same recoil reactions. Okay.
You go for your life.
All right, mate. You've been working with Roger for some time now?
Correct.
Okay. What do you think of that method of searching for the intrinsic value, then linking it to share price?
Okay, I've been in the markets for 3 decades and I've never seen anything like it.
Yeah.
And I was a CEO of quite a large fund management business for 11 years and decided to leave there, and I did a lot of due diligence on Montgomery Investment Management, and I sat down and I went through the process, and I liked it. I liked it because I thought it was highly replicable, highly repeatable, very consistent and very rigorous. So it had all the right attributes for me, and what it did was it kept you out of trouble.
And I'll get you to defend this one, because I always tease Roger because he's got a lot right. He's one of the few people in the country who picked ABC Learning as being a complete dud when most people thought the company was going okay. But then companies like Wesfarmers, he hated that because there's too much debt, but it's done well. And Telstra's another one that's done well.
Yeah.
How do you sleep at night when you get those ones wrong?
Well, okay, we've got 3 products. All of them have outperformed their benchmarks considerably since they were launched. So we have a game that we play, and we're very focused on that game. And what that game is buying very, very high quality businesses when they sell at a discount to their intrinsic value. So what happens is, for example, with Telstra, our view of their intrinsic value is, for example, $3, has been for probably 8 or 9 years. So we just won't play that game. Full stop.
Okay, and what some people would be wondering, David, is there has to be inbuilt in your assessment of Telstra an assumption of what they can get out of NBN, but you don't know. So when you can't come up with a reasonable assumption, I guess what you work on is what you can deal with. So the curveball could be, NBN could be surprisingly good for Telstra, and you just say, well, we didn't know that, so we couldn't factor it in, and we can't operate with guesswork in our system, so we get that stock and just ignore it. Is that the thinking? Exactly
right. So, as a simple example, Telstra over the last 8 or 9 years has been a disaster. Now, look at, say, an alternative like M2 Telecommunications, floated at 20.
I taught Vaughan Bowen.
Well, I admire Vaughan immensely. I think he's one of the great corporate leaders of this country. So, 25-cent share to $5 since listing, and most importantly, 70% payout ratio virtually the entire way through. So, you've had a 20-bagger in capital return, and you've had superb dividends all the way through. So what I ask people is, do you want to be in Telstra or do you want to be in M2 Telecommunications? It's a no-brainer.
Okay. So is M2 still a good buy, or has the market price gone ahead?
Look, it's made 2 enormous acquisitions. Primus May last year, and the recent announced acquisition of Dodo and a brother company of Dodo. The first acquisition was $190 million. This acquisition is about $248 million. Clearly, Primus, I think, is going quite well because they've moved from that acquisition to this acquisition within about 10 months. So, really, when we analyse this new acquisition, they say they're paying $248 million for it, and they're buying about $50 million of EBITDA, but the current EBITDA is about $37 million. So there's a bit of a jump from the 37 to the 50. If it gets to the 50, I think it's okay, but I think M2 Telecommunications, our intrinsic value is probably around about $5.50.
Yeah, where is it now?
They traded about $5 in the last few days. So I think it's still a little cheap, but the easy fruit's probably been picked in the short term.
Okay, fine. Now, I asked you to go look for 2 companies that you think are still in that situation where it's a sweet spot, market price is below the intrinsic value. What's the first one?
Well, the first one is the reject shop, believe it or not.
Gee, Roger and reject shop. That surprises me.
Yeah, no, it's done particularly well. I think June last year it was under $10, and now it's just gone ex-dividend today, but it's about $16.50. But essentially, it's a rollout story. As you know, it's a discount merchandiser. 260 stores today, probably going to 400 stores over the next 4 years.
Can they support 400 stores?
Oh, yes, they can. I mean, their forecast is, in fact, to go to 450. So we're penciling in 400, about 35 stores a year for the next 4 years. And that'll take their revenue line to over $1 billion, I think.
Okay, so
not quite Woolworths' $60 billion. No,
but still, it's a great success story, isn't it?
Or Walmart's $500 billion, but, you know, $1 billion nevertheless.
Okay, David, so what's the intrinsic value for that?
Well, we think it's probably worth about $19, and it's about 16.5x dividend.
Well, what's it like on its dividend? What kind of yield do you get on its dividend?
I don't even know, to be honest with you, Peter. Okay. No, not really. I prefer high return on equity businesses. So let's go back to M2 Telecommunications. High return on equity businesses, earnings growth, the dividends will look after themselves. And actually, I agree.
You're such a cavalier kind of guy, David.
Oh, well, I actually did disagree slightly with Bill Moss. I mean, although he's obviously one of the great
luminaries.
And you look at, say, something like National Australia Bank. I mean, it's lower now than it was 10 years ago. So I think this idea of just buying A or buying B or buying C is not actually correct. I think you've really got to pick the right stocks.
Okay. Now, the second one, Silverchef?
Yeah, Silverchef. So it's a funny little business.
Tell people about it.
Okay, so it's capitalised at about $190 million, so it's quite a small stock. It leases equipment to the sort of restaurant, industrial kitchen, cafe type area. It's got a new business that sort of competes with Flexi Plan, and its earnings have been growing since 2005 at about 20% a year, and I think it's forecast for its earnings to grow at about 20% a year for the sort of next 2 or 3 years. High return on equity, about 25 percentage points, and again, it's performed superbly. It's gone from about $3.50 to $6.80. In the last 4 weeks, it's actually put on $1, Peter. So I would be disinclined to be buying it today. I'd like it to sort of pull back somewhat. But I think if it can keep doing what it's doing over the next few years, I think $8 is certainly, certainly a shot. Okay, so you say it's added a new part to its business. Explain what that new part is. Well, basically it was really focused on sort of the hospitality industry. And what it's done is it's moved into a new area, which is much more sort of general leasing, I guess.
Was that why you brought FlexiPlan into the equation?
That's right. So they generally don't have large corporate competitors. So they're quite a specialist business. And, you know, if you do the old Porter analysis, you like businesses that don't have very good competitors, and they're one of them. So this new division is growing at about twice the rate of the old Silverchef division, and in fact now accounts for about 1/3 of the total business. And I think on a 3 to 4 year view, it'll exceed the old Silverchef division.
Is it very different from the core business, or it's just an innovation around a similar thing?
No, it's just an innovation.
So that worries me when a business is doing well in one good area, then they go totally into a diversified area.
No, you're absolutely right. I mean, it's really just an extension of what it was doing, and it picks the sectors in which it plays in a very focused way. In fact, Alan English, who's the founder of this business, the chairman and 38% shareholder, you know, he has done a wonderful job. As I say, it started in 2005, and it's been growing its EPS at about 20% a year. And you know, in Australia with a small population, you don't get a lot of opportunities like that.
Why has it done so well? Obviously, you know, people like you and Roger have been talking about it.
Oh, I know. I mean, look at the coffee shop mentality of Sydney over the last decade.
It's going to get bigger. It's not going to get smaller, is it?
And you know, you just multiply that out to the cafes, the restaurants, and so on and so forth. And so for a lot of new businesses, it's easier to lease than go and spend $20,000 on a lot of equipment.
This raises a good question. I'm sure people out there saying, well, okay, David and Roger can look at a company and say, been doing really well. How important, say for example, Silverchef, is the macro story? If we fall into another recession, how recession-proof? Like Reject Shop is great because it tends to do well in recessions, doesn't it?
Yes.
Silverchef.
Well, the issue about any of these leasing models, really, at the end of the day, is they need to get capital.
Yeah.
So if the capital markets completely freeze, as they did in late 2008, 2000 and early 2009, that is an issue for these businesses.
Yeah.
And it really does impinge their expansion plans.
Yeah. And I guess if cafes are going broke, they won't be paying their leases as well. They could have bad debts on
Yeah,
their,
that's
on
right. Bad debts and impairments will go up.
Yeah.
That's a fair comment. But what we're seeing is a lease book at the moment that's about $230 million, and management is confident they can double that lease book over the medium term. And I'm saying sort of 3 to 4 years, so growth of sort of 23, 24, 25% a year of the lease book. But that obviously assumes that capital markets don't freeze.
Yeah, and I guess the other side of the argument is also that businesses like this, obviously are relying on some of the supply funds to them. Are they linked with a well-known financial institution?
Yeah, so Westpac will be an example, have been quite collaborative to their business model.
So they must have a feeling that this is a good business model, otherwise they wouldn't be jumping into bed with them?
Well, at the end of the day, the banks don't want to muck around with $10,000 lease here and a $10,000 lease there and a $20,000 lease somewhere else. So what they're doing, it's probably a bit like Optus and M2 Telecommunications. They say, look, we don't want to muck around with the small fry. You guys do it, and you do an exceptional job at it, and you buy from us, so it's good for us.
Yeah, okay. Great stuff, David. Thanks for joining us on the program.
My pleasure, Peter.
I don't think I tease you at all, really. Maybe it's just Roger's natural personality. You're just dying there. We'll give him a bit of a wind-up.
And we didn't even get onto Cyprus.
That's right. Well, one last thing. Do you think instability in Canberra rattles investor confidence?
Oh, no doubt.
Yeah, no.
I mean, the old story, as Hawke once said, if you can't govern your own party, how can you govern the country?
Yeah, it's a pretty fair observation. David, once again, thanks for joining us on the program.
Pleasure, Peter.